Hello and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. In this episode, it's very interesting. I'm going to be replaying two short interviews that I've done. The first interview took place actually like 4 weeks ago with the Daniela Cambone show. And so this is before the outbreak of war in the Middle East. And we talked about, at the beginning, my supply and demand analysis for the market for precious metals and how that can cause really significant instability in those markets, both up and down. So volatility up and down in the marketplace. And we also talked about the implications of inflationary fiat regimes, which exist around the world, and the breakout of hostilities and international conflict. So that was an interview taking place almost 4 weeks ago. And then the second interview was with my friends at Liberty and Finance, and that took place only days ago. And of course, in this interview, they wanted to know a lot about the impact of the war and my outlook in the short, medium, and longer term for this kind of conflict and what we've seen so far in that war. And most importantly, we talked about a traditional issue that you might have seen talked about or written about by other Austrian economists, where war is used as a diversion for problems that exist on the home front, in the home economy, as Mises would talk about, that it was war is an ultimate concluding phase of the process of progressive interventionism. And of course, this ties in nicely with what I've been talking about on the podcast and in other interviews with respect to financial issues, business cycle type issues, what's being called by the Fed, for example, the liquidity problem, when in actual fact it's really a leveraging crisis that's impacting the American economy and our business cycle in areas like private equity, private credit, eventually things like insurance and pensions and things of that nature. And then we also looked at the impact over the last couple of weeks of what the downdraft or crash, you could say, in precious metal prices has been on the psychology of silver stackers and investors in gold and silver, linking that back up to the first section of the interview. And then we conclude by looking at and reiterating the longer run trends that have developed in the American economy, not just over the last few weeks, really, but over the last few years, many of which are not even really recognized in the mainstream media or in the mainstream financial press. And those long run trends that have emerged are, of course, the switch over from the lower and lower interest rate environment that occurred over many decades into the emerging long-run trend of higher and higher interest rates, which have emerged during this crisis and were emerging prior to this crisis. So that long-run trend still seems to be intact. And then, of course, higher commodity prices that I've talked about, the change in the long run trend from lower and lower commodity prices on that long run trend over the last several decades. And then the emerging new longer run trend of higher and higher commodity prices, which we have seen certainly before this crisis, and the crisis, the war crisis in the Middle East I'm referring to, is looking like it's going to only accelerate the long run trend in commodity prices. If you look at the index of commodity prices, there's a couple of indexes out there that calculate the price level in commodity prices. Both of them are up sharply in this war scenario, but they were already on a longer trend up. So we have higher interest rates, higher commodity prices, and as part of the upward trend in commodity prices, of course, gold and silver initially led that charge up in higher commodity prices. And I would say that there's nothing to suggest, even with this crash in precious metal prices, that long run trend has been somehow switched off or reversed, but rather that's a short term correction that harkens back to both the liquidity crisis and the unusual supply and demand conditions that we've already described and we already knew existed in the market for precious metals, gold and silver. So a very interesting contrast to an interview that just came out last week, but it was recorded more than 4 weeks ago, and then the Liberty and Finance episode, which was recorded very recently. So I hope you enjoy this episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute.
Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. Well, in a world of endless money printing, skyrocketing debt, and eroding trust in fiat currencies, one signal rings louder than ever. Gold isn't just rising, it's sounding the alarm bell. Joining me today is Austrian economist and Mises Institute senior fellow, Dr. Mark Thornton. He'll break down why gold prices are flashing red warnings for the economy and what it means for your future. Dr. Mark Thornton, so great for you to join us today.
Oh, it's my pleasure.
I've read your work, followed your work, and let's start with your general thesis around the yellow metal and why you are so bullish.
Well, I've been talking about this for quite some time. I've been on the podcast now for 2 years, and I've seen the United States in particular moving towards a hyperinflation scenario. And of course, gold and silver are international global markets, but the global economy is based on the US dollar. And I make my case that we're on the on ramp to hyperinflation because of the concern I have over the value of the US dollar. And that's really both in terms of the demand for the US dollar and the supply of the US dollar. On the demand side, we're seeing a fall off in the demand for the US dollar, primarily, of course, and everybody knows this, is in terms of central banks around the world turning away from US Treasury bonds and towards gold as a reserve asset. And now gold is now more than 50% of total central bank assets and reserves. And so their demand is diminishing for dollar denominated assets. And then, of course, people all over the world are also concerned about the U.S. Dollar. And, of course, there's huge buying internationally. The Indians and the Chinese, the Turks, and other places around the world, there's been a spike up in the demand on the part of individuals in various places around the world, and they're moving away from the U.S. dollar. So the demand side does not look good. And the supply side, of course, is even more intense in the sense that our government, the US government, and governments around the world are spending money like crazy. They're borrowing money like crazy. So that's national budget deficits. And there's a huge accumulation of national debt that has occurred. And of course, that's a very serious and humongous concern. The United States has $38 trillion in national debt and counting. And of course, the Japanese, the British, and many other countries. There was a scare with the French debt uh, more recently. And so that's a huge burden and threat on the world economy. And of course, the marker that we're looking at is in terms of all of that, the spending, the deficits, and the debt, is the interest payments that governments have to make um, on a regular basis. And of course, in the United States, interest payments on the debt are going exponential. And that's also happening, of course, in Japan and other countries around the world. So all of the fundamentals are, as you say, I mean, it's an emergency. It's a flashing red light, and none of these governments are really doing anything about the fundamental problem. So unfortunately, I mean, this is, it's good for investors and individuals to know about this, that gold is the safe haven asset and the long-term picture looks very bright for it. But more fundamentally, it's a real threat to the economy and our standard of living.
We'll jump right back, but this is important. Many of you are asking the question right now, what does all of this mean for my savings and retirement? Because during periods like this, your retirement can rise while the currency underneath it quietly loses purchasing power. Most people track market risk, but almost no one tracks dollar risk. That's exactly why Taylor Kenny here at RTM Trading will be breaking it down in a live webinar called Devalued Overnight, Protecting Your Wealth Through the Reset. It's happening Tuesday, March 17th at 9:30 a.m. Pacific Standard Time. That's 12:30 here on the East Coast. It's free, it's live, and there will be a Q&A. Reserve your seat using the link in the description below. Very well said. And three key points I want to go back there. I want to go back to one, the central bank buying. Yes, we know it's been fueled by that. The trend has not slowed down yet. I guess the question I have for you, Mark, is one, what happens if we do see a slowdown? I mean, do you think that if the gold price keeps rising, central banks might say, okay, well, we have enough now, or they might wait for a pullback? I mean, does it vote against us, I guess is what I'm asking.
Well, that's a very good question because, as I explained early in January, uh, especially with silver, but it's also true with gold, is that the demand for gold is relatively inelastic. And the supply of gold is relatively inelastic. I mean, there's only so much you can do with recycling, and there's very little they can do in the short run in terms of mining. So both the demand and the supply is relatively inelastic, and central banks coming into the picture and buying noticeable amounts of gold is really the driver for this higher price of gold. And so even a small cutback could dampen the increase in the price of gold. I think the long run trend is definitely up, but just like any other market, and in this market in particular, a slowdown would be have a noticeable impact on the rise in the price of gold. I think that's going to be the case. But I mean, there's other drivers of that, and for example, the international conflict that's emerging over the last year or so. I mean, we have the United States in conflict with most of the other countries around the world with tariffs, interventions in Venezuela, posturing towards Greenland, posturing against China, and now, of course, our military preparedness against Iran. All of these, that's a lot of international conflict. The world is broken into now all of these blocks, these mostly trading blocks, which is not good. But trading blocks lead to other kinds of conflict, and it can turn into a military conflict. And so, that kind of conflict is going to offset or maybe even encourage central banks to add to their gold
Yes.
holdings.
Yes.
So it's a question of certainly of risk, and the rollout of events, so to speak, in the world economy.
And Mark, when we're looking at other aspects influencing the gold price, any insights, or do you think it could also be a part of the Bitcoin crowd, perhaps fed up with the pressure on Bitcoin, perhaps re-questioning their position in Bitcoin? Are we seeing that money flow into gold? Any insights there?
Yes, I mean, I think one of the reasons it took so long for gold, and gold was really depressed at depressed price levels if you look back 5 years or so. Um, and I think a lot of that was people looking for an alternative to the US dollar, especially initially. They were looking for, an international currency, a stable currency with a stable, privately generated supply of money. And so I think a lot of young people really went into cryptocurrencies rather than gold. And
Hmm.
now that cryptocurrencies have semi crashed and are not looking all that strong right now, I'm not making any predictions there, but I think that the crypto crowd is exactly the type. I mean, they're first mover type individuals. They're smart, they're young, they're risk takers, and they're following gold. Even if they hadn't have invested in gold, they're following gold and silver. And I think that there's a natural inclination there to diversify over into the precious metals on the part of that group in particular, especially in the United States, where gold and silver holdings by the average individual investor is really teeny in comparison to China and India and Turkey and other places around the globe.
The other point, just to look at the economy in general, and I'm happy you brought up the debt because I often have experts on the flip side saying, we've been hearing about the debt, the debt's not a problem. As long as we're servicing the debt, and that's what we have been doing, the US won't be in trouble. What do you say to the naysayers or folks that brush off the trillions we've accumulated in debt?
Well, when you're the world's largest economy, and, if you look back decades and the national debt was only 30% of gross domestic product, the overall size of the economy, that's not too bad. But now it's over 100% and growing very rapidly. And that 100% has been indicated by long historical studies as a point of no return. And that's when I started looking into this issue as a threat of hyperinflation. And now, if you took in all of the US government debts, in, you combined them all, it's 120% of gross domestic product. So it is a very serious concern at this point. And, just if the audience wants to pull up, Google interest payments by the US government
Yep.
and look at it in any terms, nominal terms, real terms, inflation adjusted terms, as a percent of GDP, as a percent of the budget. I mean, interest payments now are projected to go over, all defense spending or all discretionary spending in the next, 8 years. So it's really a dramatic, and that's all, of course, according to the Congressional Budget Office. And if everything goes according to plan, if we get normal growth and normal inflation and things of that nature, and I'm really concerned right now
Yeah.
that interest rates could rise. I think we've entered, in terms of the global economy, I think we've entered an uptrend in long term interest rates. in the global economy, and it's very difficult for any single central bank to fight. I mean, they control the short-term interest rates, but they have a very difficult time controlling longer term interest rates, which is the 30-year and 20-year US government bonds. Controlling those things is a shockwave symbol to the world economy that, don't trust the US government debt.
Unless you print, print.
Well, that's right. If you print, that's what you would have to do. The appointed new chairman of the Federal Reserve has always is expressed sympathy for the idea of yield curve control. Where you're sort of controlling all lengths of U.S. government debt, the short-term Treasury bills, the long-term 30-year U.S. government bonds. But of course, if you do that, and you're not on a gold standard, then the value of the US dollar is going to plummet. And as it plummets, of course, we're going to see like rise in oil prices and international goods coming into the United States. And of course, gold will react first and foremost. That's the thing about gold is everything in the world economy affects the price of gold. The price of gold is a global commodity, and it takes into consideration all this. So we would expect gold to lead in that reaction to yield curve control.
I think you're right on track there. And if I could just take it one step further, I think with the appointment of Warsh, coupled with Besant in there in the administration, we know they're heavy gold pasts, right? Do you think that there is some sort of plan tied to gold that we're headed towards?
You mean in terms of revaluing it and all of that? Well, that's a little bit. Um, I love good conspiracy theories, and I think government is nothing but really, if you break it down, a conspiracy, particularly on the part of the power elites out there that really control the system. And I think it's really important for your audience to realize that is that the average American voter doesn't control this monster, that the class of power elites that we really don't know, that have
Yes.
only come to light really with the Epstein files and things of that nature, do we
Yeah.
really have a grasp on who's controlling our Congress and Senate and unfortunately the president and what they have hatched but of course they're uh, they're the ones that are engineering people like Warsh coming into the Fed and Bessette coming into as Secretary of the Treasury. So I'm aware of this, and I am keeping an eye on it, but it's hard for an economist to analyze that particular type of thing. And, I think most commentators just say, well, they're going to revalue gold at a certain price, but I'm not sure what that actually means. If they just want to revalue the US gold holdings, well,
Right.
that's one thing. That's an imaginary figure. If they're not going to buy or sell from the US gold stock, then it's irrelevant. And if they want to set the world price at some level, well, that means they're going to have to buy and sell. And I don't think anybody is currently contemplating the idea of the U.S. selling off its gold hoards into the marketplace. I wouldn't necessarily be opposed to that, and it would temporarily suppress the price of gold on the world markets, but it would also, of course, undermine the value of the dollar.
Interesting. You
And
would
and
not
I think that's what
you
they're
wouldn't
looking
be
for.
opposed to that. You wouldn't be opposed to the US selling part of their gold, a portion.
Well, I guess I hadn't really thought about it all that much, but I'm just here to analyze it. And if they did do something like that, it would temporarily uh, suffice some of the demand for gold. But in the longer run, of course, people believe in the US dollar because they know the US has this huge pile of gold that it collected during World War One and World War Two. So, that's been a big backing for the value of the US dollar. And it would seem, I wouldn't put it past the globalists and the power elites to want to drive down the value of the US dollar. President Trump has spoken in favor of driving down the value of the US dollar, supposedly with the idea of making American industries more competitive on international markets. But of course, a lower value of the dollar would dramatically increase price inflation in the
right?
economy.
Okay. I'm loving this conversation. Let's talk about something that is truly not conspiracy theory, and it's how employment is decoupling from economic growth. So January of this year, 108,000 layoffs. It's the highest since '09. That's 30,500 people losing their jobs every single day. Um, Amazon cut 16,000. UPS, we know, slashing 30,000. These layoffs are occurring while GDP continues to grow at approximately 4%. Um, let's get your general thoughts on the economy. I mean, is this part of your thesis of why you think gold is flashing a major red signal here about the economy?
Yes, but in terms of analysis, it fits in extremely well with what's called the Austrian business cycle theory, the business cycle theory of Ludwig von Mises. And he was, this was 100 years ago when he published a book on this topic. And basically, it's when central banks increase the money supply, as they have been doing for years, and artificially suppressing interest rates, as they have been doing for many years. That stimulates the economy and it raises prices in the long run. And a lot of economists agree with that. But the Austrian business cycle theory explains that a lot of that new investment goes into capital intensive industries with advanced technology like artificial intelligence is just a good example of a current case. And it stretches out the structure of production in the overall economy, and it has a tremendous first round effect of helping people that have a lot of wealth and that are in control of these particular industries, technology industries. But it also has a suppressing effect on the overall economy, and in particular on the working class in the economy, people without a lot of wealth that don't benefit from the lower interest rates the same way that stockholders and owners of advanced technology companies can benefit from those low interest rates. So the Austrian business cycle theory explains perfectly not just the business cycle and not just higher prices in the long run, but also the K shaped economy. The fact that it's not just a long term trend when they do this kind of thing, but there's a separation in the economy where the wealthy individuals owning the technology industries go way up, and the people without wealth that can't take advantage of the low interest rates, they see their wage rates stagnant or declining, their employment opportunities stagnant or declining, and their real incomes, their real standards of living declining as a result of this. So it's not just that there's more money being injected into the economy, but it's who's getting that money really.
Right.
And what prices are they driving up? Well, they're driving up stock prices, they're driving up bond prices, they're driving up land and real estate over the intermediate time frame. But the people who don't have real access to this low interest rates, they're dependent on wages. Well, their jobs are not receiving, you know, the rank and file working class. There's not a lot of investment in their industries, and as a result, their industries like manufacturing, construction, and so forth are not necessarily improving. And their real wages, because eventually these prices hit everybody. But of course, the median income family, those higher prices do a lot more damage. They don't have a huge portfolio. They don't have a lot of investments that benefited. They're only getting the long-term price increases, and so their labor market is stagnant, and their standard of living, their inflation-adjusted incomes are declining as a result.
Dr. Mark Thornton, just want to get a question in before we wrap on silver. Thoughts on silver? Are you as bullish silver as gold?
No, I'm much more bullish on silver. That's why I wore this tie.
Oh, wow.
That's
Okay.
why I wore this tie.
Okay.
Yeah, and I had an episode of my podcast, Minor Issues. It's the first episode of this year, and it was all about why this market is so dynamic, and in both directions. Given the inelastic supply and inelastic demand, I can't give investment advice, so I can't come right out and say it. But if you watch that episode, you would be very leery of what might happen in the first part of this year as far as silver is concerned. Now, I would note that gold and silver are still up 20% year to date. Okay. So, yes, volatility, maybe even more volatility, but volatility works in both directions. So you have to have the stomach for
Yes.
this kind of thing. But going back to the hyperinflation, being on the on ramp of the hyperinflation and concerned about the US dollar, well, if you own real money, actual money that was decided in the marketplace, pure and simple, that's gold and that's silver. I mean, the American money used to be silver coins. The trading money, the investment money used to be gold. And so if you can get yourself out of, the currency of the US government, which
Yes.
is in doubt, it's at risk, and move it into real money, gold and silver, then you can insulate yourself from some of those problems. But I must point out that just owning gold and silver is not going to make the world a safer place, and it's not going to do away with these problems of inflation and the Austrian business cycle theory problems that I just had the great opportunity to explain. So, it's not a cure all. We have to fix the monetary system. And that's, not going to be done by the Fed. I can guarantee you that. It's not going to be the power elites are not going to say, oh, look at what we've been doing to the American working class all these years. We need to reform ourselves and take away, this tool that we've been using to enrich ourselves. The
Exactly.
American people have to take it back themselves.
But when there's no end to the criminality, I think the only thing we can do, and you're right, it doesn't solve all problems, but I feel it at least gives you some power back. And I think
Yes.
the sooner we can, educate, especially if you're a parent, educate our children. I mean, that's what I'm trying to do. At least I took my kids down to Stack's Powers the
Well,
other.
and that's what we do at the Mises
Yeah,
Institute. We try to explain how the market works, not just that it works and just accept it. We explain how the market works and why government always creates more problems, why it's systemically problematic for the economy and our standard of living. And we do that, for children in high school, college,
great.
professors, the general public. We have conferences, we publish books.
That's awesome.
We have the greatest web page in the world.
I love that. Well, thank you uh, for all the work you're doing. And you really surprised me with your silver answer. I didn't know you were more bullish silver than gold. I mean, I'm not sure if you're familiar with Michael Oliver's work. I think he's the most bullish I've heard thus far. He says he wouldn't be surprised to see silver prices anywhere between 3 to 500 by summer of this year.
Yeah, I know Michael very well. He's spoken at our conferences before, and he has a background in Austrian economics. If you know Austrian economics, you'll see him refer to the Mises Institute, Austrian economics, the business cycle theory, and he'll make
Yes,
corrections when he says inflation. He's usually talking about monetary inflation and distinguished from price inflation. So, the framework is important. Now, Michael's work is based entirely on technical analysis, so it's not
correct.
straightforward Austrian economics. You're
Correct.
getting the flip. I'm giving you the flip side of Michael's coin, essentially. Um, and it's a reinforcing supply and demand dynamic.
So when you
That
hear those numbers, it doesn't shock you, Michael's numbers.
No,
Enough said. Um, I love this conversation. Please come back soon, Dr. Mark Thornton.
I'd love to. Thank you.
I have so many more questions for you, so we got to get you back on. And thank you for working with me through this snowmageddon today, but we got it done.
Welcome back to Liberty and Finance. We're delighted to welcome back Mark Thornton, a member of the Mises Institute. Mark, today being Tuesday, March 17th, 2026. Thank you for coming back on Liberty and Finance.
It's great to be with you, Dunagun. Happy St. Patrick's Day.
And happy St. Patrick's Day to you and to all those out there. We wanted to talk with you about the importance of the Mises Institute, not only for what it tells us about the importance of real things, real money, real economics and freedom and free markets, but how areas of concern right now where we've detached from those realities and are heading off for the benefit of a few and to the detriment of the many. And right now, we've got some major geopolitical strife that is burning up a lot of economic resources and throwing off a lot of our financial stability, sending signals that are very difficult for both individuals and businesses to respond to. Can you talk to us about some of this geopolitical turmoil and the impact that it's having on our monetary and financial world?
Yes, Dunagun. Ludwig von Mises wrote about, and I've been speaking about for many years, the problems of interventionism of government in the economy and protectionism, and how that leads to international conflict between nations and eventually can result in war. And that's precisely what we've seen over the last several presidential administrations, going back to Barack Obama, Trump 1, Biden, Trump 2, and it's coming forth with more protectionism, more international conflict. And now we find ourselves in this turmoil and this quagmire in the Persian Gulf, a conflict seemingly between Israel and Iran, with the United States caught in that trap. And now the whole world is at risk because of the flow of oil and natural gas and all the related chemicals, and most especially fertilizer from the Middle East. So people, they associate oil with gas in their gas tank, but it really affects the household budget tremendously in many, many different ways. It affects American business in terms of chemicals. It affects agriculture in terms of fertilizer. It affects our electric bill. It affects transportation of everything back and forth. And we're just apparently getting started with this conflict. The rise in oil prices has been sharp, but I would caution that if this is to continue, and the Strait of Hormuz is continues to be shut, and oil The price of oil could go dramatically higher. The price of natural gas could go dramatically higher. And the fact that the U.S. Currently produces enough for its consumption would not isolate us or insulate us from those negative effects. All of these markets, along with gold and silver, these are world markets and they achieve world prices. And Americans and Westerners are certainly not going to be isolated from this. And of course, right now, there seems to be a stalemate. Generally speaking, there's not an all out confrontation there, but if there's heavy destruction of the Iranian oil industry and also Saudi Arabia and the other Arab countries in the region, if their facilities for producing oil, processing oil and natural gas, and transmitting oil and natural gas were to expand, then the impact might not just be significant in terms of much, much higher prices, but the effects could last for years and years and years. Currently, the world economy is in a precarious position. Prior to this war breaking out, in terms of our business cycle and our economy, and this could really be quite dangerous, if not catastrophic, to people's standard of living around the world.
In addition to standard of living impacts, as we saw, for example, during the COVID lockdowns, which pretty much enveloped the entire world, the global international supply chain proved how fragile it was in our just-in-time notion that everything will show up when it needs to, that the interdependencies between different countries for essential goods and essential materials was brought into stark relief during those disruptions to the long international supply chains. As you point out, even when we say, oh, we've got our own strategic domestic supply of petroleum and natural gas, for example, but a lot of those materials that are manufactured goods from overseas that are brought into our country would not be benefiting necessarily from the fact that we have domestic petroleum resources here within the walls of the United States. Any further comments from you on the likely or potential far-flung aspects of supply chain disruptions to the global economy that could impact not only other countries, but also the U.S.?
Well, in the previous case, with the exception of the Russia situation, oil and natural gas flowed fairly seamlessly in the economy. And oil and natural gas is the master ingredient. Energy is the master ingredient in all of our economic processes. It's the beginning of the whole supply chain in all various directions, and as I pointed out, it's fertilizers for agriculture. There's nothing more primary than that. And it's also oil is responsible for all of the plastics. So your plastic bags, your plastic trash bags, everything that's plastic, all sorts of hospital and medical equipment. I mean, the list really goes on and on. Don't think of it just in terms of the gasoline in your car. And of course, that also affects electric vehicles. So nobody is really immune to the greater problems that are involved here. And, so you start at ground zero. Things could be catastrophic there in terms of the destruction of the oil facilities. But of course, those countries at war always do crazy things. There's no easy stopping points. People become ruthless and unhuman creatures in war. If they were to launch weapons against the desalination plants throughout the Middle East, you could have 100, 120 million people without access to drinking water. in that entire area. And of course, the airports, the ones that we control, the ones that Israel controls, and other countries, they're already being attacked. So, the Middle East is important in that respect. And, catastrophe there is going to emanate outward in all directions. And I don't think any of this was really thought through prior to the attack. And I think that the United States government, of course, is trying to suppress the initial reaction in terms of oil prices. We've released a large amount of our strategic reserves to try to contain the oil price in the oil price market. And there are indications that the American government is trying to suppress the increase in prices by manipulating the futures market in this respect, trying to cover up with current inventories, which don't last very long at all, the long run problem that's going to emerge throughout the world. Imported oil from the Middle East is vital to certainly to Pakistan, India, China, Southeast Asia, Japan, South Korea. All of those countries are going to be paralyzed without exports of oil and natural gas. And but as I said before, these are world markets with world prices. So the ultimate effect is going to spread around the world, and nobody is going to be immune to it, whether it's you or your customers, whether you're globalist or anti-globalist. Everybody is going to be affected by this. There's no way around that. And we can only hope that this clear heads are going to prevail, that peaceful minds are going to step forward and put an end to this insanity in the Persian Gulf area, bring this to a close before we have a catastrophic, inhumane problem in the Middle East, and that's going to spread out. And it's really, if fertilizer prices goes up, that means food production is going to go down. And it's not like we have years and years and years of excess food supply just sitting around. So people are going to have a diminished diet without question. The planting season is upon us. And that means people are going to starve, potentially as a result of this, and, through no fault of their own. I mean, these people are going to be located maybe 1,000 miles away from the war zone, completely without any direct connection to the course of these events, and yet they are going to experience extremely negative consequences as a result.
It's been said that all wars are bankers' wars. You've talked about the K-shaped recovery, if you could call it one, that's been evident in our economy, where it seems that the few are benefiting greatly and the many are getting farther and farther behind. Can you talk to us about the monetary impacts of hostilities like this? And in terms of cooler heads prevailing, we just heard the news come out that it looks like the administration has set its sights on Cuba next as another target just today. So any thoughts from you on the monetary impacts in ordinary people's lives of the kinds of things we've seen before in these times of volatility and hostility?
Yeah, well, the K-shaped economy, which has come into our vernacular over the last couple of years, is explained in the Austrian theory of the business cycle and inflation. And basically, when a government inflates its paper money supply, it reduces interest rates. It's a huge advantage to the wealthy, the people who have access to the banking system at a very high level, and they can leverage up their wealth in terms of stocks and bonds and land ownership and real estate ownership. So they, with those low interest rates and leveraging up their assets, they make out like bandits, and they become super duper wealthy. But that money doesn't isn't accessed by the working class generally, and the working class only receives higher prices as that money filters its way through the economy. They pay higher prices. And so that explains why the upper income and wealthier classes, they see a continuation of economic growth and prosperity, whereas the working class is dragged downward along the K, and doesn't benefit, but and has to struggle really to maintain itself, and is, against running against the tide. So this is a very unfortunate situation. It's a very unfair situation, but the Austrian theory also explains that this phenomenon cannot continue, that we have these business cycles where once that inflation works its way in, the central banks are forced to cut back where credit is much more difficult to find, especially if governments are in the markets soaking up a lot of this credit. And a liquidity crisis ensues. And that's essentially what we're seeing right now that's starting to emerge. The Fed, addressed the liquidity situation after Thanksgiving last year. They've been injecting large amounts of money to solve the so-called liquidity crisis. But what we know from following markets is that this has ended up precisely in an area that has benefited the wealthy Wall Street class, and it most importantly in the area of private credit, private equity, private banking, all of those areas, those new areas. It's very similar to the junk bond phenomenon of a previous generation. And now that area is being revealed as untenable. As the Austrian business cycle theory says, that eventually you're going to have these black swans emerge in private credit, private loan, private equity is emerging as a problem. They're not, people can't withdraw their money. BlackRock and so forth are discouraging people from withdrawing their money. And it's really emerging as a big problem. And of course, who's holding the bag there? It's life insurance companies, pension plans, things that are supposed to benefit the rank and file working class, is left holding the bag here. The profits have already been made, the commissions have already been earned by the Wall Street class over the last several years as a result of this phenomenon of living kind of like Count Dracula, draining the lifeblood from the economy. And now all of that is coming home to roost at the same time as this terrible situation of war in the Persian Gulf area has commenced.
Mises talked about free markets. We've just talked about why these are not free markets. He also talked about real money, and you've talked about just now the flooding of liquidity of currency, fiat currency, which is the farthest you can get from real money. Can you explain for all of us what you see as the likely near and midterm impact of that flood of liquidity that's likely to be continuing, it sounds like, in your view, versus real sound money such as silver and gold?
Well, it almost seems as if this war was initiated to cover up, the coming sort of denouement in the American economy and as a way of diverting attention and covering things up and shifting the blame from the Fed and the U.S. government, which is spending and borrowing and inflating like crazy and has been for years. And now that the problem is starting to emerge, all of a sudden we've got this diversion over in the Persian Gulf that they can shift the blame from themselves to some foreign land and some Ayatollah and all of that kind of nonsense. But if the life insurance and insurance companies um, go under, if the pension plans go under, if all of these private equity firms and all of the things that they've created, these entities that they've created, if that all starts to go sour, well, of course, and as a matter of fact, we could see very soon the Fed is not supposed to cut interest rates at the next meeting, but if they do cut the rates, even though they have this liquidity facility that they've already put in place, but if they cut interest rates, that's a sure sign of course, their mentality that they'll bail out, the situation politically with a flood of new money from the Fed. And of course, that's the idea there is to solve the problem politically. The government's doing something about it, and also just to to cover it up and to initiate the process, that inflationary process that got us into the situation to begin with, setting the stage for even higher prices in the future.
So, what role do you see gold and silver playing for ordinary people and for sovereign states through this next phase of history?
Well, I know that a lot of silver stackers have been really psychologically harmed by the run up and the run down in prices that has occurred since the end of all of January up and then all of February down. And, so they've been greatly discouraged, but I think they've given up on the strategy and philosophy of stacking, which means you spend the same money stacking on a regular basis, no matter what. And, so we had that big run up, we've had that big run down. We're getting close to the long run trend upward in gold and silver prices, and we may overshoot that to the downside. But the fact that we're close to that long run trend in metals prices means that in stock market terms, I guess, we're near a bottom. And and so I that's harder to tell in the metals themselves. But I think with the miners, the companies that are actively producing and selling gold and silver, I know that their balance sheets have looked much, much better over the last couple of quarters as they've been selling gold and silver at $50 an ounce or $5,000 an ounce for gold. Their balance sheets have improved tremendously. Their outlook has improved tremendously, and that's going to continue even if we stay here in metals prices, or even if we overshoot those trends and go even lower. Those companies are still going to look better. And I think that along with the manipulation of oil markets, of course, we've also, these markets in particular, people have suggested that they have also been manipulated in some form, beyond the fact that a new class of speculative investors came into the market at the end of last year, at the beginning of this year, and now they, sort of skedaddled out of this market as the need for liquidity started to emerge in earnest at the end of January of this year. So there's been, that initial move away from gold and silver is now seen as a move towards liquidity. And what we've seen in these first couple of weeks of this war in the Persian Gulf area is a move towards liquidity. And people have been selling gold and silver. They've been selling stocks. They've been selling bonds. Usually the dollar has moved up, which also kind of is a short term suppressant for gold and silver. But people have not been moving into U.S. government bonds, which is a traditional safe haven, which means that liquidity problem has been pretty severe. But these are all the short term fluctuations that we see around the longer term trend in gold and silver prices, which continues, I think, to remain up in a world in which the supply of U.S. government bonds is going to continue to expand, and this war is going to expand it even more. And in a world where interest rates has established a new trend upward in interest rates, and where commodity prices have also seems to have experienced a shift in trend from downward commodity prices to upward commodity prices. And all of those are long-term trends or long-term trend changes that we've seen just in the last couple of years, which means that if that's the case, those are things that will be in place over a long period of time of many years. And we will see short term deviations. I mean, that's the meaning of a trend, that markets move around up and down, above and below what the trend is, an arithmetic average of those changes. But in terms of the supply of government bonds, the upward trend in commodity prices, and the upward trend in precious metal prices, those appear to be long-term upward shifts in the trend line.
Mark, for those who want to find out more about the Austrian economics and all the educational educational resources that are available, Mises.org is on your banner behind you. MISES.org is where they should go.
Absolutely. It's free. It's open. There's no registration. It's one of the largest economic web pages in the world, and it's written for everyday people. We do have academic books and academic journals, but we have many daily articles on every topic imaginable, including a lot that we've discussed here today. And we also have several podcasts that come out on a weekly basis on economics, economic theory, policy, and just a whole variety of topics. So I think it's very important because, just being for free markets is really not good enough in today's world. We all have to really understand some of the basics about, and we have a whole series of video lectures on the very basics right on the top of our homepage. But we teach why markets work. The nuts and bolts of why markets work to students, the laymen, professors, graduate students, college students, why markets work, how markets work, and how and why governments always fail in promoting human society, and why they always are drags on or lead to the destruction of our standard of living. So I encourage everybody to do that. And we still have a book giveaway of F.A. Hayek's greatest hits articles. Happy to send you a free copy of this. And some of the essays that Hayek wrote, and he was a Nobel Prize winner in economics. He was Ludwig von Mises's student, and he was the intellectual backbone for Margaret Thatcher and Ronald Reagan in the 1970s and 80s, which saw us come off of the horrific results of going off of the gold standard and making some reforms that improve the American and world economy up until the present anyway. So, there's some great essays in here, including, I think is very important, why the worst always get on top.
Mark, we're always grateful for your presence here on Liberty and Finance, and this is a very good example of that. Thank you for joining us on behalf of all of our viewers and subscribers. And folks, check out Mises.org, MISES.org. Thank you, Mark.
Oh, you're very welcome, Dunagun. Great to be with you.